As you're getting ready for retirement, it's helpful to have a roadmap or a guide that tells you some of the ways to make the most of your retirement benefits and tells you about some of the pitfalls that you definitely want to avoid. So that's exactly what this is. We're going to cover all of these topics right here and then a couple of others. So let's get started. First, we have some critical dates that you want to be aware of and put on your calendar as you're entering retirement. The first important date is Social Security. So you want to sign up for that 3 months before you want to start getting income. So you can start getting income as early as age 62, but claiming that early results in a reduced benefit. And that benefit reduction lasts for the rest of your life, and it could potentially affect a spouse. If you have a surviving spouse who's going to take over your income after your death. So it's a big decision. Now you can wait until your full retirement age, or you can keep on waiting until age 70, which gives you the maximum monthly benefit. There's no point in waiting after age 70. Doesn't mean you can't retire at age 62 or earlier, but you want to just be aware of that reduction. Next, we have signing up for Medicare. And again, you want to do this 3 months before you want to get your benefits. So for most people, Medicare starts at age 65. If you happen to work for an employer who gives you health care coverage after that age, you want to talk with your employer, check with your benefits department or the health insurance company, preferably both, and ask them what exactly you need to do to coordinate with Social Security. Again, once you're ready to start getting those benefits, you want to apply 3 months early. Now, let's say you retire well before age 65 and you had some health care from your employer. Maybe you're going to go on continuation of benefits. That might be COBRA from your employer or a state continuation if you work for a small company. And those continuation of benefit programs typically last 18 months. So you want to mark that on your calendar. Again, not right at month 18, but a couple of months early, start looking for alternative health care coverage. So you might be able to stay on your employer's coverage for that 18 months. And then what do? You might get your own individual plan through an exchange, or you might go on a spouse's plan if you happen to be married and your spouse has health care that you're eligible for. We want to start looking into those options as soon as possible. Next, we have your required minimum distributions, or RMDs. Those required distributions are something that the IRS wants you to do to start getting taxable income and get that money out of pre-tax retirement accounts. So starting in 2020, the age for that is age 72. You have a little bit of extra time on your first year, but in general, you want to be on top of this at age 72. There's a stiff penalty for missing those RMDs, so make sure you get this either automated or that you have it done in a way that you can stay on top of it every year. And of course, there might be other events that are specific to your situation, so make sure and get those marked on the calendar, set up some reminders for yourself so that you don't miss anything. Next is to review your investment risk, and this is particularly important as you reach retirement. That's because in the academic papers, they call this sequence of returns risk. But basically what it means is you don't want to have a big market loss right at retirement or in the early years of retirement. And the reason is, as you're taking withdrawals from your accounts, if there's a big crash in the market and your accounts suffer, that can really make an impact on your resources and can make it harder for your money to last the rest of your life. So we want to make sure that you're taking the right amount of risk. That doesn't mean no risk necessarily if you want to keep your assets growing and try and keep up with inflation, but we don't want to have unreasonable risk in your investments at retirement. Next is to have an income plan, and that means knowing exactly where your income is going to come from each month, giving you the money that you spend on things like food and healthcare and fun and everything else. So a lot of people have Social Security or a pension from an employer. You might have an annuity that is paying out income to you. What we do is we add those up to form your base of income. So you might have, let's say, $1,500 a month of Social Security income, plus another $1,000 of pension income. So you've got $2,500 as your base of income. If you're like most people, that might not provide everything you need. So what do? You look to your retirement assets that you have built up over the years. That might be in your IRAs, your individual retirement accounts, or your 401k, 403b, etc. through your employers. Most people, unless you are fabulously rich, most people need to spend down their assets over time. So you don't just live off the interest in most cases. As nice as that sounds, you're typically actually withdrawing from the principal that you have saved up. So the question becomes, how much exactly can you withdraw, and how does that work with your income needs and your income plan? Well, there are two ways to look at those withdrawals. One popular strategy is known as the 4% rule, and it's not necessarily a rule, it's I guess a guideline or a study that figured out how much exactly can you withdraw from your savings in a 30-year retirement. It's a typical 30-year retirement. So that says that you can take out 4% of your starting retirement assets. So if we use $1 million as a round number, 4% of that is $40,000 a year. Or if you have $500,000, 4% of that is $20,000 a year. That may sound low, but the way that works is this. You actually increase the amount you withdraw each year with inflation. So that's why we need to start with a somewhat low number. The other reason is that this is what's called a safe withdrawal rate, and that goes in air quotes because nothing is guaranteed or safe. But the academic studies have shown that that should last for a 30-year retirement. Just to go with that $1 million example, let's say you start out with $40,000 of withdrawals in the first year. That goes on top of whatever you're getting from Social Security or pensions. You know, that $40,000 plus, whatever it is you're getting is your income that you can spend. In year two, let's say that there was 2% inflation. So we're going to increase that withdrawal from $40,000 to $40,800. Again, we've increased it by $800 to keep up with inflation, and hopefully that helps you keep your standard of living for all of those 30 years as you make these gradual increases. Another popular strategy is the bucketing strategy, and that's what you might call buckets of money. What you do there is the first bucket kind of makes sense for most people, in fact, and that's that you're going to have the first several years of your spending needs in cash, totally safe, no market risk. It might be in FDIC insured bank accounts or insured credit union accounts, and that money is going to cover your first 3-5 years of spending, depending on how conservative you want to be. Then we have a bucket behind that, and that bucket might be slightly more risk. So it might be a moderate risk mix of investments, not 100% stock. That's probably not what you have in there. But as you use up the cash from your first bucket, we're replenishing the cash with income and things we sell from the second bucket. And then, of course, behind that, you have another bucket that you don't plan to touch for 10 years, 15 years plus, and that can be higher risk investments. The way that works is you look out at that bucket and you say, I don't really care what happens with the investments there because I have time for them to recover, and assuming you believe that that's what will happen, then you don't have to stress about what's going on in the markets. You have your cash bucket for your next couple of years you're taken care of. You've got some relatively low risk investments after that to replenish and cover the subsequent years. And then you've got your long-term portfolio. The main criticism of the bucketing strategy is that it may leave you a little bit cash heavy because it does tend to have a lot of cash. And there are pros and cons to that, and it depends what the markets do, whether that's good or bad. But that's a quick overview of the bucketing strategy. Next is to plan for healthcare expenses in retirement. And what that means is to have some idea of what it's going to cost you, where you're going to get the money from, and how all of that is going to look. Where you're going to get benefits if you're before age 65, all of that. So I have another article that digs in deep there, tells you what the annual expenses might be or the total retirement expenses. Those can be big, scary numbers, but I think putting it in context can be helpful for you to kind of make a plan and understand what it might look like. I'll put a link to that in the notes here. But the main thing is you just want to have some idea of what healthcare looks like, because you're no longer working for an employer that might cover some of those costs and deal with all of that for you, like make choices on which plan you have. Now it's going to be your responsibility to handle most of that. This is also a good time to look at what might happen if you or a loved one are incapacitated or if you pass away. So start looking at those estate planning issues, look at your healthcare directives, that kind of thing. Just get ready for, increased healthcare events to happen, and just make it as easy as possible on your loved ones. Next is inflation, and this is something that some people miss when they're kind of doing calculations. They say, how much do I need to spend in retirement? And we want to make sure that you're looking at inflation adjusted numbers when you do that. So whatever $100 buys you today, it might not buy you the same thing 5 or 10 years from now. It might cost $102 or $106 or whatever the case may be. So you want to factor that in and make sure that your calculations have increasing costs over time so that you are able to afford those things that increase in price. Next, we have the question of what do you do with the assets in your employer's retirement plans? You might have multiple plans. You might have a lot going on out there. So that means things like your 401k or your 403b, your simple. What do you do with those? So in general, with those types of accounts, you have a couple of options. One is to leave it with the employer. That's not my favorite option because your employer is kind of in control of everything. They may need to sign off on distributions. They may have restrictions on exactly how you can take withdrawals. Maybe they don't want to give you monthly income. They just want you to take the whole thing. If the employer merges or changes the retirement plan, your funds might be frozen temporarily. These are all reasons to maybe take control of it, and that's option 2, is to move the money into your own retirement account. That might be like an IRA, an individual retirement account, and the benefit of that is that you control everything. Now, before you make that move, you want to make sure and compare all of the features and costs against what is going on in your 401k plan or your other employer plans, and really know which is best for you to keep on using or to switch to, whatever the case may be. With an IRA, there's no tax consequence generally when you move from your employer plan to the IRA, again, the individual retirement account. So it's not a huge tax increase if you move over $500,000 or something. What you do is you end up taking out as much as you need. That might be $1,000 a month, or it might be every once in a while you call up or you go online and you say, send me $4,000 because you have an expense. So you have full control over what's going on in those IRAs, and you can manage how the taxes are going to hit your return. A third option is to just cash out that money, and that means have them make a check payable to you. Again, this is not my favorite option because let's say you have $500,000 or $1 million saved up. That's going to look like you earned $500,000 or $1 million in that year, which will bump you up into pretty high tax brackets. So if you don't need all of that money in cash right away and you don't feel like paying all of those taxes right away, it might make more sense to just roll the money over to a retirement account. Plus, if you're under age 59 and a half, you might have additional tax penalties. There can be complications on when you have to make estimated tax payments, no matter how old you are. It can just really get problematic. So what about pensions from your employer? Well, you have several choices there. Sometimes you have the option to take a lump sum of cash versus monthly payments from the pension. So you want to evaluate the pros and cons of that. In a lot of cases, it makes sense to take those monthly payments, but you might want a lump sum of cash more quickly. You might look at the numbers and find that it's better to take the lump sum. It just depends on a lot of different factors. You might, for whatever reason, just feel better about having the lump sum. Or you might say, you know what, I want that monthly payment to last forever. They might guarantee that a spouse continues, if you're married, they might guarantee that a spouse continues to get 100% or 50% of the monthly income. Those are some choices that you can make as you select your income options. So there's a lot to look at there with your pension. These are the types of things you want to look at probably a couple of months, if not a couple of years before you retire, because the sooner you start doing this, the less of a mental burden you have and less pressure you have once you reach retirement. Next, we want to think about home equity. So if you happen to own a home, there may be some equity in that home that can possibly be either a supplement or a safety net. Maybe you never want to touch it, but at least it's there in case of, catastrophic healthcare events, that sort of thing. Just remember that that's there and kind of think about how you can access that. There are a couple of ways to do that. One is just downsizing. That's probably the simplest option. If you want to move to a different place, that's a good opportunity. If you want to get rid of stairs that you could get injured on as you age, it's a good opportunity to downsize. You can simplify life. You can declutter, all that kind of thing, reduce your expenses, maybe stop making mortgage payments if you buy a less expensive place. And if you do that, you may be able to keep some of the cash, or you have some sales proceeds that you can use to supplement your income or to provide, again, a safety net. Another option is to use a reverse mortgage, and that is where you're going to stay in your current home. You have to be at least age 62, and there are, of course, other requirements, but you stay in your current home, and then you either take monthly income or you have access to a line of credit. These types of programs have been, they were pretty bad in the past. They've gotten quite a bit better, but you want to be very careful about what you're doing. You want to have conversations with your loved ones if that's a factor. Do they want the home to be in the family? Does it not matter? What's going to happen if one of you leaves the home and the other doesn't, if there are multiple people in the home, married or not? I mean, these are all things that you need to discuss. But the point is that it's good to know that you have perhaps that safety net or that supplement available. I should mention I'm Justin Pritchard. I'm a certified financial planner, and I'm in Montrose, Colorado. But I help people all around the U.S. plan for retirement, manage investments, and do other financial planning things. So please let me know if you'd like to talk. Please also subscribe. It does not cost you anything. You can do so down in the red thing on the bottom, and it helps me out a teeny bit, and it can help you out as well as you get more of this information. So I hope that helps.